Hi, Saugat. How are you?
Hi, how are you? Who's this?
I'm good. This is Jagat. Hope you remember
Hi.
when you were in Blackstone.
Yeah, right. Hi, Jagat, how are you? How's things going on there? Yeah, it's pretty long time, so I haven't seen you. That's why I forgot. That's when I was in Blackstone. So, yes.
Yeah, I missed to attend your last session. I saw it on Facebook. I thought I'll attend it, but sorry, I could not.
No
So this
worries, no
time,
worries.
yeah.
So now let's start. Okay, I think we have like 21 participants right now. So let me start with the session first. So let me introduce myself. Yes, I'm Saugat. I'm a chartered accountant by profession. And yes, I'm a registered valuer under security and financial assets class. It's basically, guided by the Insolvency Bankruptcy Board of India. So as my past experience, I was working in India for last 10 years. So my past experience purely belongs to valuation and investment banking. So now I'm here in Nepal and just try to, share my some past experience on valuations and investment banking. That's my first motive. And I just want to, utilize this time post-COVID lockdown. I just want to utilize this time frame just to want to share my experience, right? I'm not here to, teach you all people, but it's more like my proactive approach just to share my experience, what I have learned in the past 5-7 years in the valuation side. So continuing this today's session, for today's session, my topic will be a startup valuation using a VC method. Yes, a lot of with the techniques which we can use for a valuation of startup companies, but purely I'll be focusing on a venture capital method, which basically says the VC method in short form, right? So I'll be guiding you through some sort of practical approach. Yes, there will be some sort of theoretical background, and apart from that, I'll be giving you practical implications and how you run the model under the VC method using these techniques. So yes. So moving forward, so I just want to give you a brief snapshot of my webinar for today. Yes, my basic fundamental, my approach will be, to give you a hourly 1 hour presentation in every week basis, so that I can deliberate in a more comprehensive way regarding the valuations. Right? Now, so as far as the valuation is concerned, right? So I'll be delivering this in the bits and pieces. Not it's due to time constraint and all stuff. So I'll be try to share my experience in the bits and pieces. So for last session, I have developed one model for the weighted average cost of capital and the cost of equity. How to compute that, the basic fundamental drivers for the valuations in the last session. So yes, I know few of them have already was present in that session, so it might be helpful for those of you. And if not, then I will be sharing you the link again, so that you can be going through that concept going forward also. Right. And yes, this webinar will be purely a practical based approach, a learning approach. Well, I will be demonstrating you on Excel based also. And for today, my session will be purely based on startup companies and the valuation, how to value startup companies, basically using a VC method and this kind of things. Right? And for whom? So yes, my target audience are there, very scattered target audience. Some of might be some have no relevance experience in this domain, and very much of you are like from a very different background. But yes, that's really helpful to understand the basic principle of valuations, and basically for entrepreneur who wants to raise funds, or for those investors who want to for like seeking investment from other investors. So that will be really helpful from this session. So these are the overall broader category of the target audience for today. So I'll be focusing on for those entrepreneurs who are seeking investments from a private equity and the venture capital firm, right? So I can see a lot of audience from my India also. So I'll be delivering this session purely in purely in English, so that we all are in the same line, right? So in my last session, some of the participants give a feedback that I sometimes use a Nepali language, but yes, most of my target was a Nepali audience. But having said that, the few of them are from the India as well. So today I'll be deliberating all of my session in the English only. So moving forward, so these are the Zoom link. You can copy this Zoom link to invite others as well. So for the timing. So always remember, right? So valuation, what is valuation? Valuation is really subjective. It's a biased thing, right? It can't be precise, right? So there are a lot of value drivers. There are a lot of driving factors that really, factor your valuation, that really factor your assumption, that really factor. There are a lot of things that needs to be considered, right? But the basic premise is like from a valuation perspective, price is always what you pay, right? So if you see like in the stock market, if you are going to buy a stock at 10, that's a price. That's not a value. Always remember that. So that could be a differential perspective from a valuation point of view, right? So from Warren Buffett, he always says like price is what you pay, but value is what you get, right? So that's the basic principle, fundamental aspects of the valuation. So if you see about the intrinsic value, that could be the intrinsic value means the from an investor point of view, if you are targeting some sort of future cash flow, so that's a value of your company, right? So if you discount that cash flow to the today date, so that's your value, right? So from an investor point of view, you're always looking at forward-looking assumptions, right? So you have been capturing the cash flows and all stuff. There are a lot of challenges to how to predict, how to precisely measure this cash flow going forward. So that could be different from industry. And yes, from a startup point of view, it's very difficult to precisely measure the cash flow, right? So it's very difficult. Now, so yes, there is a lot of degree of imprecision between the how to precisely measure your cash flow, and there are a lot of driving factors from the valuation point of view, like discounting factors, like nominal value. There are a lot of things to do, right? So these are the factors which really determine your valuation, right? So how to precisely measure? So from a stable company point of view, yes, there is somehow a little bit practically possible and practically feasible to predict your cash flow, but from a startup company's point of view, it's really impossible. And it's precisely not measurable from, right? So yes. So in nutshell, we must say that in a startup company, rather than investor looking after some recurring cash flow in the form of capital appreciation or in the form of dividend payouts, from an investor point of view, we'll be looking after the exit, right? It's an overall value creation at the time of exit only. Not he will be focusing on the day-to-day dividend payout, but he will be focusing more into the the value creation, which will be happen at the time of exit, right? So that's a more fundamental premise of VC or a private equity firm look after before investing in any sort of startups companies. Yes. So today it's all about startups, right? From a very stage to stage companies, from a very seed capital to growth capital companies. So it's all about the phase of investments where the small startup companies will be looking after investment. Yes, there is in every economy there is a lack of capital. Yes, so every economy fight for the capital creation, right? If you talk about the Nepalese scenario, yes, there is a lot of vacuum in the startup culture, right? So once the the economy got matured and once the economy got transferred from the initial stage to some technology enabled economy, so there will be upswing of this kind of startup startup culture, right? If you see in India, right, so there is a light of if you see the total foreign direct investments in India, right, so almost 80% of the FDI is coming from the startup companies, right? So that's how a value is created for a startup company. So lot of foreign investors are willing to invest in India, right? So in this kind of VC or private equity domain. So that's a major upswing we can see nowadays in the startup economy. But here in Nepal, so in terms of the capital creation, government has a lot of restrictions. You must say, like if you see the foreign direct investment rules, so there is always the approval route where a government is focusing on a 5 crore of investment. So it's a minimum threshold before investing in any company. So if a company is in a very nascent stage, like how that company will be able to capture the value of that capture the value of that capital, right? So obviously that is also one of the drawbacks. So we should look after. So now moving forward, so my basic fundamental difference of a mature company versus a startup, I have tried to I have tried to break up that into two parts, where I will categorizing a lot of factors from the startup point of view, where the company is a very nascent stage, and yes, the mature company having a stable cash flow and profitability margins, right? So if you see, so there are a lot of differences between which is more precisely we call it a venture capital investments and a buyout investment, right? So from mature company perspective, it's a buyout investments where a company will be more mature, having a stable cash flow and the profitability margin in terms of growth and in terms of size, right? But in terms of venture capital investment, it's more a very nascent stage, right? So there is a low predictability of a cash flow, right? So we can't predict much precisely how cash flow will be going forward in the 5 years down the line or 10 years down the line. It's really biased, right? So now, so yes, in terms of the product portfolio, that could be very uncertain, right? So the product is in very nascent stage, or there could be some sort of minimum viability product line, like it's some sort of prototypes or first paying customers are there. So it's a very nascent stage, right? We must say that in the capital investment. So these are the challenge we face, like how you precisely measure the going forward projection of a company, going forward projection of a business, like. So yes, normally this kind of startup is very asset light as compared to some brick and mortar investments in the old brick and mortar investments. And from a equity investment point of view, they are purely backed by the equity or some sort of quasi equity sort of things, like especially in the Nepalese context, like there is no collateral for this kind of small company, so there is always a lack of capital for this kind of company. So first, their main target is to capture the capital from the near and the dear ones, and the family and the friends, and then after then look after some sort of investment from a VC or the private equity fund, right? So bank will never finance these kind of projects, right? Bank will never finance because they are asset light and there is no sort of collateral for this kind of companies, right? So that's a major challenge we see. And in terms of the operation, yes, there is a high cash burn. So in terms of cash burn, what's cash burn, right? So from a mature company, if I invest suppose 1 rupees in a startup company, and if I invest 1 rupees in a mature company, so then I will be getting a value add on the 1 rupees which I spend in a mature company as compared to startup company, which I'm going to burn, right? So burn basically means a net operating cash outflow, right? It's basically like revenue. It's negative EBITDA, right? Negative EBITDA, and yes, there will be some sort of capital expenditures, and there will be a working capital, right? So this kind of the outflow which we have to which we have to like give the company in the form of the capital infusion. So there is no as such kind of other measures to run this company apart from a majority equity financing point of view, right? So yes, so these are the parameters from where we can distinguish purely a venture capital investments and the buyout investment, right? So in the one side of venture capital investment is a very lower part of the spectrum, and in the buyout investment, it's a very higher part of the spectrum, where there is a growth perspective. And yes, in the venture capital, it is a very nascent stage investment, right? And in terms of investments in the VC funds, so it's in very nascent stage, and yes, from investor point of view, they will be looking after some sort of goals and milestones during the tenure of the investment, right? So once he invests the seed investment and once he invests the growth capital in the company, so in this intervention period, so he will be looking after some sort of milestone that could be a customer base, a revenue, other some sort of the operating margin profile, and there are a lot of milestones that can be looked after, right, from the goal setting point of view, from a VC investments, right? So these are the main parameters which a VC capital investment look after before investing in a startup company, right? And yes, being an investor, being a very risk averse investor, so he will be requiring high returns in case of VC investments. Yes, like as compared to a mature economy. So yes, there is a risk, and so that's why from investor point of view, he will be looking after more return, right? So that's why from a VC investments, he will be targeting a higher return as compared to a mature company return, right? So these are the distinguished factors. So now moving forward, so what happens in a VC investment normally, right? So if you see in the left side, he's an investor, and in the right side is the P investments, P invest and a venture capital firm, right? So they will having a handshake, right? So it's a deal which has been materialized, right? So it's a long way process, right? So before materializing of any VC investments, but the normal parallels of a VC investment is that a founder or prospective, the entrepreneur, try to get much as funding as he needs, right? And always he try to, lower the, dilution. It means like he wants to give away a little ownership in the company, right? And on the right hand side, as a VC investors, he will be, his perspective is a different one. It's exactly opposite what the founder is saying, right? So he will have a lower valuation, and he wants to have a relatively large stake in the company, right? In the lower valuation. So that's why there is always been a battle between the investor point of view and the entrepreneur point of view, right? So once this kind of the conflict, it's more like a conflict which should be resolved, right? So there are a lot of factors that should be factored in before resolving this kind of situation. And once the situation get both interests are aligned, so they will be having a handshake, right? So then the deal get tracked, and the VC investment will come to the company, and the company will start operations, right? So that's how it's a purely subjective matter, where on the left hand side it's a founder, and in the right hand side it's investor. So they will be having some sort of negotiations, right? So it's also about the negotiation skills, how you do that. So always remember, right? So as I have told you in the previous slides, from investor perspective, right? So in the investor perspective, from a VC investment, right, I target to demonstrate purely a venture capital or a private equity fund, right? So in a normal, what's the structure of this kind of funds, right? So if you see in the Nepal context, there are 2 or 3 private equity funds. One is Dolma, and one to us, and there are 2 more B2O, BO2, and 2 or 3 venture capital firms, right? So how these firms are normally see, the structure of this firm is this, so the PE or VC firm is called general partner, and once he have a management and some sort of PE, so they will be having a partnership with the limited partners to form a PE or VC fund, which is a limited liability partnership firm, where they will the VC or general partner will be getting a management fee for the tenure of the the cycle of the funds, which is normally like 10 years, and some 2 or 3 more years can be there. But yes, normally 10 years will be the life cycle of the fund, right? So once this fund of investment is created, this investment will be in the portfolio companies, right? So these are the portfolio companies that could be in any stage, right? So from an investor point of view, this portfolio company could range from small startup companies to from a buyout transaction where there will be a more matured company, right? So always remember that there is no as specific hard and fast rule from at which investments, at which stage an investor will invest in, right? So normally a VC firm will invest in the lower spectrum companies as compared to a private equity where they will be targeting a growth capital, right? Companies which need a growth capital to grow, right? So these are the categorization of the portfolio companies. So yes, I have already told you that there could be early stage startup companies where a venture capital investment will be there, right? And there will be mature company where there will be buyout transactions where company will be have a stable cash flow in the form of they already have a market penetration and already have some sort of matured cash flow and EBITDA positive companies, right? So this kind of this kind of structure is a limited structures where they have almost like 5 to 10 years of life cycle, and once the the life cycle exists, the company will be get exit, right? So exit could be in the form of IPO, buyout, liquidation, or strategic sales, right? And that will be repatriated to the limited partners in the form of profit. So this is how a normal private equity firms works, right? In the so Vivek, you have any questions? I think you have shown your hand.
I have a question.
Yeah, Vivek, please.
Okay, this is about the investors and the startup negotiation.
Mm-hmm.
Because the investors, they are not buying the company; they are just trying to invest the company. So the money that is required is always required.
Right.
So how would they decide? because they have to invest some sort of money in the market to get themselves grown.
Mm-hmm.
I mean,
see,
if they are negotiating,
mm-hmm. Mm-hmm. So see, there is always a capital vacuum, right? For a startup company, there is a capital vacuum. So they need a capital, right? So some investors normally from startup companies, but if you see, there are a lot of, the entrepreneur who want to dilute their stake for about, 40-50% stake in the company, in the initial stage, right? So, but there is always a negotiation in terms of there could be like, sectorial, some, PE funds have the, mandate to invest in some sort of equity in the like technology sectors, some have in healthcare, and this kind of sector agnostic are there. So once these investment mandates fits the criteria, then they do have an initial screening where they have some sort of investment criteria. So it will be a long process, but normally speaking, there is a negotiation process. So yes, and valuation is also one of the part of negotiation, right? So yes.
No, I mean, I'm saying that they are going to value the company and they are going to invest in the same way.
Mm-hmm.
The company in any way, company will be trying to get as many funds as they can.
Okay. So I'll be, yes, your concern is very right. I'll be targeting this your concern in the next slide. So yes, from investor point of view and from the VC the entrepreneur point of view. So I'll be targeting the concern in the later slides. You'll be having the answers. Sorry.
Sir, I have one doubt, sir.
Okay.
Sir, like, what is the actual difference between a PE firm and a VC firm? Like, how they differ from each other?
So from a venture capital firm, right, it's more about the stage of operation, right, stage of investment, right? So if you see the VC investment, they do have an investment mandate for a very national stage company. So they do at very risk averse firms like VC firms, right? They have a investment mandate in the tech companies where they will be seeking more risks, right? So yes, from the stage of operation point of view, VC will invest in the lower spectrum, and as compared to PE, where they will be targeting the growth capital, where the company will be having some sort of maturity in terms of margin profile and the size, and yes, they do have some sort of capital, market traction. So that kind of company, a PE will invest, and from a lower spectrum, a VC investment will be there. Yeah.
Okay, sir. Thank you.
So moving to the next slide. So how much to raise the investment, right? So Vivek, yes, this slide will answer your questions. So yes, I have seen a lot of entrepreneurs like they are much not aware of how to raise the investments first thing, and how much to raise the investment, like so they don't know how, what's the capital requirement for their ventures and how much they are willing to divest in the companies, right? So a lot of entrepreneurs, they do have ideas, but they initially stage they look for the VC firm. So what will be there, like they will end up with diluting the stake for more than 40-50%. So that's not good thing, right? So first of all, how much to raise the money. So it's three things, right? So first the cash in, right? One is the cash out and the milestone achieved. So these are the normal life cycle which a VC firm will follow, right? So in the cash in perspective, so it should be clear, right? So a VC investment will be it's not like that, right? So there is always a guidelines, and they will always be willing that level of investment which is exactly required by the entrepreneur, right? So there will not be a capital overflow of capital, and there will not be over underflow of capital, right? So yes, in terms of capital flow, so that will be funded by the venture capital investment, which will be funding your cash burn, your working capital, and the capex part, right? So these are the three broader categories which we look after an investment point of view, right? So from a VC perspective, there is always a mentality there. They are not going to invest too much in the cash in the business, right? So from they said that too much of resources lead to a burning of cash too quickly, right? From entrepreneur, they will be urged to burn the cash too quickly. So a normal time frame of 80 to 24 months of a run rate is suitable from a VC investment, right? So they will invest in that amount in that stage, that amount which will be required to sustain that company for a long 18 to 24 months of the run rate, right? So that's a normal scenario. So what's cash out, right? So once you first make an investment, so there will be this situation. So if you see the graph, so let an investor invest $10,000 in the quarter one of this company, right? Quarter one. So the situation is here. Like if you see the spike in the graph, So it's a cash in, right? So it's investment which is made by the VC fund, right? So this fund, the company is not self-sufficient enough. So it's a cash burning business right now. So where the company is, burning the cash going forward, right? So now from this investment point of view, if you see the milestone achieved, right? So if I see for the 18 to 24 months, which is more probably like in the eighth quarter, right? So the company will be in cash out, right? So see the graph, the closing cash balance goes decrease, and at the end of the eighth quarter, you will be cash out. So in this situation, your company will need a more fund to sustain more, right? So it's a normal, scenario. Like as your business is not able to generate enough cash flow, so you will be having a source of finance only in the form of the cost of equity, only in the form of equity, right? So that's only the source of finance you have, right? And yes, in the terms of milestone, where the first stage ideating, where idea, it's only about idea, where you don't have any sort of prototype or even the minimum viability product. So if you see the the validation stage, once you have an idea and it will get materialized in the validation stage, where do you have a prototype, some sort of one single paying customers or more than that. So once your ideas get validated, you will be start scaling your business, right? So for the scaling, you need a capital, right? So I suggest all of the entrepreneurs to invest on your own, right? For this stage, for the validation stage and the ideating stage, right? So once you try to, incorporate other investor in this space, you will be diluting your stake. So it's no point, infusing the capital in this stage. So first stage, I think it's a triple F, which is called family friends. So you should be investing in this space by your own and some of your family and friends, right? So once you stage the scaling phase, so where you will be requiring more capital, that capital which you have on your own, which is not sufficient, then you will look after the VC funds, right? And once the scaling goes on, you will be establishing in the market. You have a market traction, you have a customer base, and you will be, once you have this, and you will be mature to the growth phase, right? Where you will be having a little bit of, profitability margin, and then you will target, it's a growth phase where you will be targeting more customer base just for growth, right? And after that, you will be in the profitability segment, right? So in this whole, milestone, right? So these are the milestones, and there could be a lot of sub milestone in this kind of category. But the major, the bottleneck or major things that you should consider in these three stages is the customer acquisition price and the lifetime value of the customer, right? So in the initial phase, right? So how much, it's more like, if you are investing $1 for a customer acquisition, then you will not be getting $1 of return in terms of your lifetime value in this stage, right? So it means you are in more cash burn stage in this first situation. And once you move from the first situation to the second situation, so you will be having a customer acquisition price which is nearly aligned with the lifetime value, right? So once you move from this stage to the growth stage, where you will be having a value appreciation in terms of your lifetime value, where you will be getting a more benefit from a investor point of view. If you are investing $1 in the customer acquisition, then you will be getting a more return, right? So this is a normal milestone which a normal E fund or VC fund will follow, right? So moving, what's the character of the the stages of the startup company? So there is little or no revenue, and yes, it's a binary business model, right? So a research has been done where it says after the 7th year time frame of a startup company, 70% of the startup company failed to go forward, right? So that's a bigger challenge where an investor point of view, there's a lot of risk factor for a going concern, right? So how these these risks could be measured, how these risks should be accounted for before investing in a startup company. If you see in the lower graph, so see, if I invest, thousands of the companies in the year 02, so if you going forward in the 4th year of investments, 4th year of the life cycle, 44% of the startup companies succeed, right? So out of that, the rest will liquidate, the rest will not going to succeed, right? And once it moves from the 4th year to 7th year, only 31% of the startup succeeds. So the rest of almost 70% of the startup company fails, right? So these are the major, risk factor from an investor or VC point of view, you should be look after, right? Now, so these are the normal, life cycle of the startup company, where you have the general ideas, and where it's called a valley of death. It's a cash burning cycle. It's a cash burning time frame where you will be burning cash in the form of operating losses, and there will be capex and working capital infusion in the company. So in terms of this, you will be burning cash as more in an increasing way, right? So once you mature, once you from idea to you become a startup company where you have a small traction in the market, some sort of revenue, yeah, right? So in that stage, you will be also in the loss stage, but you will be try to recover from this phase to a profitability phase, right? So once the startup company got succeed from 7th year onwards, then you will be having a second stage of company, which is more like a growing company, right? So it will move forward and have a profitability margin going forward. So that's a normal industry parallels, right? It's not that I'm just try to validate these assumptions, but it's a scientific measures, and it's a research based thing, right, for normal companies, startup companies. So in terms of financing cycle, what's a startup financing cycle, right? If you see, so in this graph, so that is also a replicate of previous slide. So it's a top line, which is basically a revenue, right? Revenue of the company, and in the x-axis it's a time frame, right? So it's an early stage company, right? As I already told, like a lot of startup companies try to go in the investment round initially in the seed capital or initially in the inception stage, but that's the wrong thing. You should be looking after some sort of investment from your family, friends, or your relatives, right? So let me do one thing. It's I think the Zoom will end up in upcoming 5 to 6 minutes. So I have a next link for the meeting. So hopefully it will not end. If that end, then you can continue in the link which I have shared right now in the meeting chat box, right? So yes, so this stage in the which I have seen in the green side, which is called the proof of concept, where they will be having some sort of successful prototype, right? Now, so in the green side, it's called seed capital or the family, friend, or some relatives investment, right? Where you will be having angel investment in this round. Once you grow from this stage to the upper stage, where will you be targeting the venture capital or private equity firm, right? So it's not like you will be directly targeting the VC funds. So first you have to target your capital raise from the family and friends, right? Once you move from this stage to this stage, then obviously you have a like some sort of run rate in terms of. So let me share again, Sandeep. So it's a new link. I hope everyone gets the new link so that you can start from there once the meeting room ended. So these are the stage of the investment, right? So yes, once the stage get over and your company will be more mature to have an IPO, right? Initial public offer, and where there can be a secondary offering and your company will get listed in the public market, right? So that's a normal cycle. So now in terms of valuation, right? So I try to describe a normal cycle, investment cycle, and the normal, the character of a startup companies. So and I now try to focus on the valuation part, right? So how to value a startup companies, right? It's a very biased thing, and it's very difficult to precisely measure all the nitty gritties and all the cash flows in the startup company. So why other valuation techniques can't be used? So in my previous sessions, I have told a little bit about the the income approach, where you will be discounting your future cash flow by using a discount rate to give a valuation of the company. So, but in this case, it's not precisely, because the company has no history, right? So normally, what's a normal science says, ontogeny replace the phylogeny. What's you have been seeing in the history could be in the forward. So there is no history in the company. So there is little revenue or the significant operating losses in the company. So you not be precisely measures the the operating losses or even the revenue going forward. And yes, as I've already told you, it's a binary business model. So there are a lot of X factor in terms of going concern also, like in the previous slide, what I've said, like 70% of the startup fails to operate after the 7th year. So how to factor in this kind of risk factor from an investor point of view, right? And yes, there is a lot of challenge in discounting factor, how to discount that cash flow and the terminal value and the time to reach the profitability is precisely not measurable, right? And other valuation measures like relative valuation approach, where you will be comparing your value with the other comparable companies just to give a benchmark valuation, right? So it's also not practically feasible as you don't have stable cash flow, stable revenue, and stable operating margins just to give a comparable valuation approach, right? And in terms of the relative approach, there are a lot of other factors like control premium. Yes, it's a little bit technical enough for like some of you who don't have a valuation experience, but yes, it's a broader thing that a normal M&A transactions or a buyout transaction, or that could be a venture capital or any sort of investment. So there is a control premium. If I want to have a control in the company, yes, I'll be investing. I will be giving a more a multiple to my valuation as compared where there is no any control in the company, right? So that's a basic parallels of the valuations. And obviously, yes, there is some sort of anticipated synergy where a buyer will be interested to give a more premium in the business, right? And some of the transactions don't have arm's length, right? So there is a related party transaction. So you don't have to take that sort of transaction basis as a comparable valuation approach, right? So it's not in arm's length, it's not in the third party valuation. You can't give a reference of that kind of. And also the geography measures, right? So yes, so now how to value the startup companies, right? So it's more, I see like it's more like a art, luck and gut, right? So it's more like art, right? Combination of art and science. And I've quickly moved forward to the venture capital. So there are a lot of other techniques which can be used to start up valuation, where the first method is a venture capital, the first Chicago, the Damodaran approach, the real option approach, the customer based valuation, the Berkey's method, and the cost to duplicate approach. Yes, it's a little bit of a technical part, but today I'll be focusing on the venture capital method only, right? So it's a basic, basic and it's easy to understand, right? So there are a lot of approach that, and there are a lot of technical skills you need to have to know how to measure precisely this kind of valuation techniques, right? So for the timing and for this session, I'll be targeting on the venture capital method, right? Which is also called as a VC method, right? Moving forward, right? So valuation of an investment in a startup company using a VC method. How to value a company using a VC method, right? Which is also called a venture capital method. So now, so see, from investor point of view, if a VC investment, right? So if a VC investors or the private equity investors invest in the company, so definitely they do have a specific time frame, right? So a normal time frame is a 5 to 10 years, right? 5 years of investment period and 5 years of exit period, right? So definitely they will be exiting from the investment. So it's not like they will be gonna have that investment like throughout their life, right? It's not like that. So in certain time frame, they have to exit from the investment. So this valuation perspective is basically from an investor point of view, where there will be a potential exit, right? Where there will be a potential exit scenario. So for this, so how would you compute the the pre-money valuation in this kind of situation where there will be an exit value? How to determine this exit value and what's the investment made? So it's more like a pre-money valuation would be a exit value minus the investment made, right? So it's a normal time frame or a line graph sort of things which I try to explain how a normal VC method works, right? So see, like let us suppose this time frame is 5 years and this time frame is 5 years, let us suppose, right? It's a total life cycle of the fund where there will be a specific exit time frame where you will be having an exit value, right? So you have an IRR which is also called expected return from a venture capital point of view. I'll be showing in the next slides how to compute the IRR and how to compute cost of capital or cost of equity from a venture capital perspective, just to discount this exit value to the second round of investment, as I've already shown in the first or second slide that this investment needs a second round of funding, right? Just to sustain for more years, right? So these are the basic fundamental aspects where I'll be discounting this exit value to the second round. And once I do the second round of investment, I will be having a second round of equity infusion, right? So once I reduce that equity infusion, I'll be getting a pre-money equity valuation from the second round perspective. And once I discount that second round of valuation to the the first round, so that's a pre-money valuation which I will be looking after investment, right? So it's a pre-money valuation, which is basically exit valuation minus investment made. So yes, the fundamental like investor want to exit, the method combines the DCF and the multiple approach, right? So how to precisely measure these kind of things? Like there are three or four factors that should be specific. Right? So first thing is expected earning, right? What is expected earning? So it is precisely measures once you have a some sort of clear identification or clearly measure the cash flow where the company will be earning that level of revenue or that level of target at the time of exit, right? So it's basically a financial modeling process. So if possible, I will be I will be giving my deliberation on this prospect also to how to precisely measure a cash flow, or it's more like a financial modeling classes, right? So where you will be learning the income statements, a balance sheet or cash flow for a projection point of view. And yes, from a 5 point, like once time of exit, at which stage the company will, grow, right? So that's a purely expected earning or revenue. So that could be a top line, or that could be EBITDA margin and other margins as well. But normally from a startup company and from a tech company's point of view, we normally take a revenue multiple, right? Just to value the companies, right? So once I get the expected earnings once at the time of exit, so that's the first stage we should be targeting our. And the second will be the multiple, right? At which multiple your investment gonna exit, right? It's not like you will getting a same exit multiple in every investment, right? But the thing is like these multiples are industry specific, right? If you see some tech heavy or tech savvy investments, like you can have a 3 or 4 times revenue multiple. That's normal thing, right? Even more than that from a technology company as compared to some brick and mortar asset heavy companies, will be getting some sort of lower multiple, right? And other factor you should consider discount rate, as I already told. Like
Saugat, I have a question. Saugat,
yeah,
I have a question.
Hi Asher, how are you?
Hi,
Yes, sir.
good. Okay, is there a thumb rule for defining the exit multiple?
Yes,
How do
yes,
we
sir.
define the exit multiple?
Right. I'll be focusing this part in the next slide, sir. I have some sort of templates.
Okay.
Yeah, I'll do that. So as I already told, the exit multiple will be depends upon two part. Like once you get a comparable listed company, or you get a precedent transactions, right? So where you will be targeting the same industry companies, or having some sort of sectors or subsectors. So there will be some sort of overlapping in the target company and what companies you are using for the valuation. So that should be taken care of, right? And the next factor is the discount factor, where you will be discounting this exit valuation from a VC perspective, right? And yes, from the growth capital and promoter exit, a lot of things need to be considered. What is growth capital means? You are directly focusing this capital for the growth of the company, not for the promoter exit. A lot of things you can see in the going forward, like promoter wants to exit from the investment, right? So they want to liquidate their investment. So that's not like that. So you have to only focus on the valuation perspective. You have to consider the growth capital only, not promoter exit. So this is how you try to build a exit multiple from every investment point. So I give a hypothetical example where this is a date of the transactions, and these are the target companies. So how to map the target company? The basis of the selection will be your industry classification. If you are a tech company, then yes, technology is the first broader categorization of industry classification where you will be targeting. And once you move deep down, so there is a lot of sub industry class, sub strata of the classification of the industry, where you will be targeting. Some are tech, some are fintech, like the e-commerce. There are a lot of sectors you can focus on. So you will be targeting the subcategorization of the industry. And yes, for the other part, like the size, the geography also matters. Like from if you are investing emerging market, then yes, the multiple will be higher as compared to a lower mature as compared to a mature economy, right? So these are the basis which should be considered before selecting the target company, right? So yes, these are also matters like the percentage short, deal value, it's an enterprise level by total income. So I have tried to replicate this, the industry, basically a tech companies where I'll be having a revenue multiple of 4.4 times, right? So it's practically feasible for the tech company, but not feasible for an asset heavy business. Like if you're for a steel sector, you are not going to have this multiple, right? It will be definitely on the lower side, right? So why an investor want to invest at the 4.04 times of the revenue multiple, right? So it's all because of growth, right? The growth if that growth is considered, then an investor can be able to invest in the higher revenue multiples. It's all factor in the growth, right? So for this, I have taken the Indian transaction multiples, but yes, my valuation concern is purely focused on the Nepalese company. So I'll be giving some sort of country risk discount, yes, and some sort of size discount as compared to the Indian market to the Nepali market, where I will be getting a multiple of around 2.40 for my exit, right? This can be used how to get an exit multiple. So once I get an exit multiple, now my next will be the target revenue exit, where I have entered in the company at the revenue run rate of 2000 NPR, 200,000 NPR, and my exit at the time of exit, I'll be getting this revenue. So it's basically a financial modeling classes. I'm just giving a reference. So based on the financial projection, right? So now, in my previous slide, I have shown you how to discount this exit multiple from a VC point of view, right? So now there are always remember there are three sources of finance. The first is the debt, the second is a quasi debt or quasi equity, and the third is the equity, right? So these are only the source of finance or source of capital from an investor. So there is no other source other than this, right? So always remember, but this blend is always possible when the company is more mature, right? Debt is possible only for a mature company having some contraction, some sort of a profitability margin, and a collateral based company, right? But in an asset light model, having a negative profitability margin, or having no any some sort of traction, no any revenue, or no any kind of market traction for this kind of company, the way out is equity, right? You can't have a debt in the startup companies, right? So no bank will fund you, so for a mature in my previous session, I have tried to build up the cost of capital for blending this source of finance to get a weighted average cost of capital. That is purely for a matured company, not for a startup company. But what extra need that should be taken care of before determining the cost of equity or any other instruments for a startup companies? Yes, so the capital structure of a startup company, right? So in this equity, which is for the mature company, I'll be getting some sort of other additional risk factor from if I invest in a startup company. So what are these additional risk factors, right? So these are the lack of diversification, right? What is diversification means? Like if I, as an investor point of view, if I invest a penny, like if I $1 of investment in that company, so I'll be blocking my investment opportunity investment, right? If that investment is purely focused on a startup, so where I'll be losing my opportunity cost of investment, right? So next, there will be a probability of failure. As I've already told you, after the 7th year of investment, almost 70% of the startup fails, right? So that there is always inherent probability of failure, right? And yes, there is these are the illiquid investments where you can't have a sell this in a open market situation, right? So there is always a off transaction item. And the next part is the information asymmetry, right? So there is always a vacuum between investments information, right? So what's a founder, what's a financialist information, what the founder is reflecting the balance sheet would be different from an investor point of view. So there is always information asymmetry, and there is always a risk factor. These are the factors that are the risks, right? So to factor in this kind of risk factors, you have to factor in the cost of equity by a additional factor, right? So these are the cost of equity from the venture perspective. Once you factor in this risk factor on the cost of equity, you will be getting a discount rate to discount your cash flow or discount your exit value to arrive at the value of your company, right? So how to factor this risk factor? So I'll be showing the next slide. So let's see. So these are basically a capital asset pricing model, right? CAPM model, where you will be having a risk-free rate, a risk premium, illiquidity or control premium to get a cost of equity. So I'm just trying to make it a more faster way. And once you get a cost of equity, you have to blend that cost of equity by your capital structure, right? But from a VC perspective or from a startup company point of view, you will be having 100% equity capital, right? So you will be having 100%. So your total weighted average will be 100% equity, right? So normal cost of equity will be around 17.65. It's for a stable company, right? It's for a matured company or having a track record and a market share, or profitability margins, and have this kind of stable companies. You can target a 16 to 7% average cost of equity in net context, right? But how to factor in that additional risk factor, which you see perceived here for a startup company's point of view? Then these are the factors. These factors should be considered, where you will be having a this Q represents the priority of failure, right? So once you assign or some sort of priority of failure to a startup company, then you will be getting a higher cost of equity. So here the higher cost of equity represents the higher expectation from a VC point of view, right? Yes, the same model which I try to replicate in the pictorial form, where there is a cash in, cash out, exit situation, where I will be investing $1,800 in the first year, and there will be the cash burn in the business, so which will be gone sustain for upcoming 2 years only. So again, in the third year, I will be infusing a $200 as in the form of cash in. So I'll be exiting from this investment at the 5th year of investment, right? So these are normal cycle from a VC investment point of view. And in terms of the cash burn, I compute the cash burn in the term of operating losses, which the company bears, and the capex requirement and the working capital infusion in the company. So these are the normal graph which VC normally sees in any investments. So from a VC investment point of view, so yes, these are the the working sheet which I will share in the Excel going forward, where I'll be targeting the entry multiple of 2.42 and the revenue during exit of 9.8. This one, and these are the additional risk factor once you discount this cash flow to this. So these are the things, right? So I'll be sharing the Excel sheet for this, where so where we'll be having the cost of equity computation and the VC method computation, where a general pro forma a financial model, which I've just taken a tentative way, but it's more, it can be deep down in the much deeper way, like so that can be seen here. So once I do this, I'll be sharing the the Excel working file with you and the presentation shortly. So any questions on this, like
Yeah, Saugat. I have a question. Like, if you see from the Nepalese point of view, Nepalese market point of view, how do you see the scope for the new ventures to come in the current scenario right after Corona? How do you see the market is going to be for the new startup?
So see, in the post-corona situation, there are 2 or 3 broader category of ventures that can be come in, right? For first is the fintech situation, right, where a lot of peoples are reluctant to use cash nowadays. Like even the WHO is recommending you not to use the cash, right? So after this kind of situation, yes, the fintech company will flourish definitely. And the next one is the the e-commerce and the last mile delivery system, right? E-commerce being a lot of if you see, like a lot in this lockdown situation, all the retail market is closed, but only the the delivery things, or only the channel which is present right now is the e-commerce, which is basically the doing the home-based essentials for the last mile delivery. And this can be the industry which we can look after going forward. The logistic, which will be basically a last mile delivery, which will be targeting like the home to home delivery system, and the startup company, which will be basically e-commerce segment. So this can be broader category of the sectors. And yes, home-based entertainment. And even if you see a lot of companies which are in the home-based entertainment, like the Netflix or other companies, they have gained a lot of value post-COVID, like post-lockdown. So yes, these are the broader category which we can focus post-COVID.
Okay.
So moving to the chat round. So yes, Ashish, I have the recording of these sessions. I will be giving the recording link once I complete this session. Yes, Pratibha, I will be sharing the link for the last session. So that last session was basically the computation of the cost of equity and the cost of debt, just to then and compute the value and the cost of weighted average cost of capital. Size of investment, investing in the company, investment, investing in the company. So I didn't get these questions, Hari. 6 minutes later. Yeah, Alkaji, if you have any questions, then you can definitely ask me. Like, yes, the 5 to 10 minutes will be definitely a question answer, session. And as we are in this, yes, Sandeep, I was trying to, complete the whole session within 1 year. So that's why I was a little bit fast. So I hope you bear me. Yeah, Hari ji, I will be sharing the information and the presentation shortly. I'll be sharing the link here where you can download the presentation and the working file. Yes, Anupam ji, I'll be sharing the Excel file too. Sure, variety of failure is totally subject comes. So, Isur ji, yes, it's a very biased thing to determine the probability of failure in a very nascent stage. But normal, if you see the cost of equity at around 16 to 17%, right? The additional risk factor that should be factored in from a probability of failure, right? So once you factor in the normal 10 to 20% of the probability of failure is a justifiable things that you can consider, for computing the. Even you can take a higher rate, right? The 30 to 40% can be also taken care of. But yes, in the normal situation, you can take a 20 to 25% of failure rate. Is the valuation required for the CCPS valuation and conversion? Yes, for the compulsory convertible preference shares, it's more like quasi equity, right? If that is the case where you will be issuing optional convertible preference shares, so it's more like a derivative instruments. But the CCPS is more like a quasi equity where you will be valuing CCPS more like a equity, right?
Saugant.
Yes.
Hari Surya here. Just
Yeah,
my
Harish.
question is that valuation is required while issuing CCPS or while conversion valuation is required generally in the startup companies. Suppose today I am issuing this convertible security to the investor. Is I need to get the valuation now, equity valuation, or when I convert after 3 years, example,
so
when
sir,
it is required?
So, sir, for CCPS issue, you should be valuing your company right now, but based on that valuation, you will be having a conversion rate also. So your conversion rate should be specifically mentioned in your, the shareholder agreement, right? So for that part, you need to value your CCPS today.
Correct.
Right.
But while conversion also I need to value once again that after 3 years or 5 years?
Yes, correct. You're right. So that's only a floor price, which we will be mentioning in your shareholders agreement right now. But once it's purely a milestone based achievement, right? Once you reach at the stage of 4th year where your conversion will get triggered. So at that time also you need to value your company, right? So, but for the timing, while issuing a CCPS, you have to definitely value your CCPS just to mention your floor price, right? Yes.
Floor price.
Yeah.
Thank you.
Okay. So what are the opportunity of VC in Nepal if I'm looking to come back to Nepal? So see, Roshan Sharmaji, VC investments and private investments are in very nascent stage right now here in Nepal. And there are 2 or 3 big players. One of them is Dolma, where I'm currently working right now. And one of 2 is called One to Watch and BO2. So these are the 3, 4, VC and the more like private, private equity firm, right? Where you can look after the opportunity if you come back from Nepal. Come back to Nepal, yes. So can you tell a few technicalities behind the failure of the startups? So Alkaji, the technicalities behind the failure of the startup could be anything, if your idea fails, right? So that's a basic fundamental aspects of failure, right? So once you've been able to capture the market based on your ideas, if that idea doesn't work, right? So definitely for like startup companies, you should be looking after your addressable market, right? How your market will be able to perceive that technology, right? Once your technology is not being able, your market is not able to perceive that the technology, that enablers, then definitely you're gonna fail, right? So basic fundamental things I think you should be looking after before using a startup company or before running a startup company is your market perspective, right? So how your market gonna perceive that technology, right? So that's a basic fundamental thing I think we should look after. So yes, there could be like the serviceable addressable market, the total addressable market, or yes, there are a lot of things that could be looked after. But I think that the basic thing we should be look after. Reserve the source of multiple computer. Yes, that's capital IQ multiple, where I have try to fetch precision transaction under different level of industry, like in the level of industry. No, it's more like a technology multiple which I have tracked down from a capital IQ. How does a business have a success for 4 years after we start on course? How does a business have success for 4 years? So Abbas, it's not a success, but it's like remain in the game, right? If you be not been able to the cash in the business, then you'll be out. You have a lot of cash burn, right? So if you're not being able to manage that cash burn in the terms of equity infusion, then you're out of the game, right? If you see a lot of the startup companies, even if you see a lot of e-commerce or fintech companies, they're out of cash right now, considering fintech. So there is a very trouble, raising capital, and until and unless this company is kind of company which requires a lot of cash, right? It's more like a cash is the king for this kind of business, right? So you're out of the game. In a startup company, goodwill, patent, experience profile. Yes, that is also one of the factor we should look after, that before getting a investor confidence, we the normally investor look after the past track record of the founder also, like if they are been able to raise capital and precisely use their capital for the growth perspective, then yes, that is also a good point where VC investor will look after from a founder point perspective. And also they will look after the sales efficiency, like the capital efficiency, like if you are investing $1 of investment in the company, so at what multiple you're getting a return, right? There this kind of situation you have to look after sort of, right? So do you have any questions?
Okay, can I ask something?
Yeah, sure.
Okay, how do this VC decide that now it is time to hand over this company or to go big?
See,
And if they have a certain timeline that they are going to invest for 12 to 18 to 24 months, then if the company or idea of any process doesn't work, then how do they decide if this is the right time to leave, or they have to sustain, or now it is time to invite some more investors?
See, like in a normal VC parallels, like there are 10 years of time frame, right? 5 years is an investment period where their mandate doesn't mandate them to exit from the investment, right? So post 5th year of investment, they can exit from the investment, right? So they will look after some sort of if you see the normal financing cycle of a VC investment, right? So see, if you are an angel investor where you have invested in a startup company, right? So what's your potential exit, right? Your potential exit will definitely not be your IPO, right? Where you can't target IPO market from a seed capital investment point of view, right? So definitely your exit will be an investment from a other VC fund where other VC will be invest to get you exit, right? So these are the step ladders, right? So once you move from the first stage to second stage, so there are a lot of VC firms under this category. There are a lot of early stage investors. There could be a growth capital investors, or there could be a later stage investors, right? So once you step the ladder moving forward, then you will be exiting from these of the investors, which will be on board going forward. And once the later stage comes, then you will be exiting through an IPO. It's normal industry parallels where it's a normal, cycle, I must say. Like, you can't target a IPO just you invest in a seed capital or sort of things. So these are the normal the steps you have to follow.
Okay, IPO being the last remedy. I mean, IPO being the last remedy because IPO would be the end result, the ultimate result, what a company would like to achieve. So before that, if a VC is investing in a company, then they would definitely want some sort of profit or some sort of, margin for themselves. So how do they decide? Because it is not sure that a company would be earning any profit within 4 years, or their
See,
time frame. So
got
how
it.
do they VC? The VC make money.
See, the only thing the VC should consider, say, in my first slide, I have said in a startup company, rather than recurring cash flow, right? Investor is targeting in the one-time value creation during the exit, right? That is only the basic fundamental aspect of VC look at. They are not concerned about the day-to-day cash flow. They are not concerned about the dividends, right? So yes, startup company normally doesn't pay dividends for upcoming 5 to 10 years unless and until it's reached at a stage of growth, right? So there is no any intervening cash flow. The only the potential cash flow that VC investor will look after at the time of the exit only, right? So that is only the value creation, not in the form of dividend or any sort of other payout, intervening payouts. So yes, you have already said the IPO is the ultimate the ultimate target.
Way out of
Ultimate,
the company,
yes,
target of the
yes.
company.
But there could be a sideways where there will be a lot of sideways scenarios, right? And there could be also a failure situation where the company will liquidate, right? There will be also a liquidation scenario. So it's all about the cycle of the company. So definitely once a company goes into IPO, there will be a cycle of investments where you'll be giving a public equity, and once you reach even that mature stage, then definitely it's all about life of the company, right? So you move across the cycle as you move forward. Yeah.
Actually, being two cases, I have one practical scenario because I have earlier worked with a company. There was a startup. The company was doing really good. They were earning a lot of money. Despite of earning a lot of money, all the expenses were handled by VCs and PEs.
Yes.
What kind of milestone are those VCs trying to achieve? Because despite all their income and they were increasing massively. Every year and every month, they were just adding up with the assets and revenues and wealth, everything. But despite of that, all their administrative expenses and assets, all procurement were handled by the VCs and PEs. So I just wanted to know, how does this VC decide now this is right time to exit, or now we cannot handle this company, or now we should let them go? I'm just talking about from the perspective of the VCs. How do they decide to earn money?
So
if they are deciding that we should sustain for more 4 years, company is doing good and they know that company will be doing good. In such case, after achieving or after going down 18 months down the road, how do they think now we should sustain or we should leave or let it go?
See, from a VC perspective, right, despite the fact the company grow, right, despite the fact the company moves from idea stage company to startup company to a second stage company, right? But the thing is, despite the fact they are earning the revenue, right, there's the top line growth, but the company is burning cash. So that needs to be funded from a VC, right? So if you see this graph, it's called a value of death, right? So for this time frame, you need to back up your investment, right? So you can't have a situation where you will be exiting at that time frame, but you need to back your investment from a VC investor, right?
You need working capital kind of thing.
No, working capital is also one part, right? But there are 2 or 3 parts you should look after, right? First is your cash burn, right? If you are earning revenue, but if you are earning suppose 100 rupees revenue, but you are incurring 150 rupees expenses to incur that revenue, so your normally cash burn only 50 rupees, right? So that's a basic operation, right, which is also called a cash burn, right? So other part, that's a one thing which is called operating losses, and the second thing is working capital, right? So there is a cycle of operating capital which should be funded by a VC, right? So despite the fact the company is growing and despite the fact company is making money, but the in terms of cash flow perspective, in terms of your working capital, in terms of your cash burn, so the company will be in a negative cash flow, right? And apart from that, the capex part, which is basically a technology enablers, right? The technology and other infrastructure that needs to be developed to achieve that target or achieve that milestone, right? So that needs to be funded by a VC fund. So these 3 broader categories needs to be funded by a VC fund, where a VC have to actively, do the investment. There is no other way out, right? So it's called a value
Okay.
of debt. So you have to sustain sustain your investment through this period, right? So once you reach a break-even level, which is at this time frame, then you can think of exit, right? Before that, you can't even think, right? Definitely, if in that situation, in the value of debt situation, if you get a new investors, which will be like other VC investments or other private equity fund, which will be willing to invest, and at that stage, then you will be exit. You will get an exit. But the situation is, unless until you reach a break even, then a normal VC fund doesn't think of things of exit. As it's all about a valuation game, right? So there are no any intervening cash flow. The only thing is the exit valuation, and the exit valuation will remain higher once you have some sort of positive milestone, right? That's a
Okay.
storytelling thing. So that's normal VCU at the time of exit.
Okay. Okay. Then there comes the time when promoter exits after just measuring, after gauging the market condition.
Correct. So see, normal, like even in the Indian case, like in the Paytm, right? At the time of demonetization,
Paytm.
right? So that was the most favorable time frame to exit the promoter of Paytm, right? So so that was the best favorable because the market was able to perceive that situation, right? So there was a demonetization, yes, and the technology platform, which is basically a fintech, gonna boom in the upcoming years, right? So that's a market situation which also trigger the potential time to exit,
Mm.
right?
Okay. One more thing. Suppose just some sort of practical approach, because suppose I'm starting up something, a business. I have a very good idea, and I know that down the line, I'm going to get some investors. So is that the investment pitch that makes difference, or the business idea?
So
Because
it's a
sometimes, despite of good business idea, business fails and they fail to get investment from the investors.
right.
So is this
See,
the business pitch that matters a lot, or the business idea that matters a lot?
business pays there is always a vacuum, right? So I see a lot of vacuum, especially in the Nepalese context, right? Where a professional, a PE funds or a venture capital, they do have on expectations, and the investors or entrepreneurs where they are pitching for their investment, they do have some sort of deliverables, right? So there is always a gap, right? So this gap should be normal standard parallels word, like even the VC or like private equity fund, like there is always a mediator, right, which works just to gap that bridge, right. So that's a investment pitch. That gap should be taken care by this kind of intermediaries, right? Yes, you have a robust ideas, and that robust ideas needs to be pitched by this kind of intermediaries, where the chances of getting the fund will be higher as compare. You have a robust idea, but you are pitching in a lower, a very some sort of rudimentary way. That doesn't make sense. Like if you have a robust idea, then you should hire a intermediate, like where they are professional enough to pitch your ideas in a professional way, where the gap between the expectation of a VC and the quality of the deliverables from an investor point of view will get matched. That's normal industrial practice.
Because we've seen a lot of practically, we've seen a lot of companies, despite having good and really good ideas, company get failed.
Right. So where are you based right now?
Sorry?
Where are you based right now? You're also working in a VC fund, or like?
No, I have done some sort of efficient work and efficiency testing for a startup company. The company was doing massively good, despite of everything. The company were funded by big private equity firms. And all their administrative and expenses were handled by the company, and they used to get millions and millions of dollars every month, maybe, because all the salaries and all administrative expenses were handled by those companies. And
Yeah,
I have
that's normal
seen,
parallels.
because the company was growing massively. They had some huge requirements every month, and they were into this logistic business, and they were doing really good.
Right.
They were not even hiring people on their payroll, but despite that, those people were outsourcing their resources, people working for them. And I've seen their practices. I don't know, this is general practice of the startup business. They were growing a lot, and they were not even in loss. There was not definitely a loss-making company.
So I guess that's a 3PL logistic, right? So in the higher spectrum of the logistics platform, not being like a brick and mortar trucking company or like just like a stuff, right? I think it's a media, just like 3PL logistics sort of things.
And company they grew massively in 4 years.
Mm-hmm.
So I just wanted to know what kind of, I mean, this is all based on idea or the pitching, the way they pitch. They're
Mm-hmm.
getting so much of fun from the investors.
Mm-hmm.
Not every time. This is how we pitch, right? If we are being able to deliver what we want to, what we want to get,
Mm-hmm.
what we are projecting.
Mm-hmm.
So that,
No, yeah, that also matter. But the thing is, like, the growth also matter. Growth perspective from VC is normally perceived, right? So that also matter. Like, like in current situation, if you want to pitch for like, a department store company, so definitely it's not going to be succeed, right? It's currently situation of COVID, right? But despite the situation, if you pitch for like some tech savvy companies, like fintech companies or like a logistic, which as you said, like 3PL logistic or the last mile delivery companies, then definitely that creates a much more value add, right, in this situation. So that's also time also matters, right, in which situation and what circumstances you are pitching for a company.
exactly.
Right. So I think that's it. If anybody has any other questions, then just let me know.
And one last question. I know you have already done this, went through this topic, but one last question. If I am starting up something and I want some investor, then how would I decide? I mean, how do I decide what percentage of my stake to be diluted? Because there is some sort of chance that I'm alone. I'm with my investor. I'm with my guy who is representing me. But over and above, there are other guys on the other side who are always trying to negotiate for the best deal
Right.
out of lowest amount they want to pay for me.
Correct.
Then in that case, how do I decide that this should be my part and that should be their part? Because this is the time where the idea, I mean, where this guy make a lot of mistakes,
Correct.
diluting their shares more than me.
So I think it's a two-way negotiation process. Like, if your addressable market is, big enough just to have a, shabby exit for an investor point of view, then definitely from an investor point of view, they will gonna invest at a higher multiple as compared to some sort of, not that charming industry. Like, so once you determine precisely your the potential market, the potential the targets, the potential of the company which you're gonna achieve after 5 years or 10 years down the line, then that's all about the growth perspective, right? So once
Okay, so this depend on, I'm sorry to interrupt you, but does this depend, I mean, is it all about the way we project our business to them? I'm saying, I'm supposing in 5 years I'm gonna make this much of or profit, I'm gonna give this to my investor. Then are they gonna decide that the investment is going to be based on the amount, the final amount we show them?
That is also one of the part, but it's not like you are building a fancy financial model just to project your business from $1,000 to $1 million or even $1 billion company. So that's not a thing. Like playing with Excel doesn't make sense just to make a investment decision. But that is also one part. But normally investors see like the enablers, like the technology enablers, the concept, and the mostly they also see the the entrepreneur if they have a past track record of running a company or like just capitalizing that technology for to create value. So that is also one of the things a normal investor would see. There are a lot of factors that can be considered before investing, but I'm just concerned about the valuation perspective, which yes, it's bits and pieces and it's purely a number game, but there are also a lot of things that should be considered before investments or from investor point of view.
Okay. Thank you.
Okay, I got a big questions from Anupam.
Okay, Anupam Pramanik, can I just say something about this? Not Anupam Ji, but Saugat.
Some of the startup companies are engaged in selling various goods below MRP.
Below MRP. Okay, can I say something about this? The question just
Yeah,
raised.
sure.
Okay. Is this because the company is not looking for the profit in the future, because they are looking for the valuation of the company, because they want their company to be present all over the place. That is why they can get a lot of traffic for the business, and this is majorly done by the online e-commerce business. Yes, majorly done by the e-commerce business, because they want all the traffic diverted to their business. Certainly, what it does is can have the applications downloaded a lot, they can have the traffic a lot, and they can make themselves visible in the market. This is
Yes,
all about the paper game, so that they can exit with huge market share.
right. So that is also the thing. But normally in the e-commerce, like the revenue and profitability is one thing, and other is the gross merchandise value, right, which is called a GMV, right? So
GMV.
it's more like a marketplace where you will be acting as a mediator between the buyer and sellers, and yes, there will be a definitely percentage share like once you provide that service. But normally these e-commerce companies target to have a better GMV, right? So that GMV is like number of transactions into the average order size. Like if you are like targeting like 1,000 orders in a month and your average order size is 1,000, then you will be having a 10 million, like 10 million of gross merchandise value, right? So despite the fact that there will be a heavy loss in the company, but this company normally, focus on the top line, right? Where they will be targeting just to pass on that benefit to the customer group, just to increase their GMV and have a better valuation. And yes, from a
Yes.
e-commerce point of view, if you see the Indian e-commerce market, it's in the consolidation stage right now. So that in the initial stage, so it's rightly said, like once the industry emerged, right? So there is a lot of copycats going on. Like once you have a better understanding of the industry, there are a lot of players which try to capture the market. The same thing happens in India, right? So now if you see the e-commerce market in India, so there are only two players, major players like Flipkart and Amazon, which is backed by like US market. Amazon, which is purely a subsidiary of Amazon Inc., and Flipkart acquired by the Walmart, right? So it's purely a consolidation stage, and where a lot of small players like Myntra and Jabong, and there are a lot of small e-commerce market players which now get merged to these big players. So the same industry pattern will also follow in all the geography. Like if you see in Nepal, there are two major e-commerce players, like the Sastotil and the Daraj. So these are the major players right now here in Nepal. But yes, so moving forward, there will be a lot of duplication and a lot of players coming in the e-commerce market, but they will not gonna sustain, right? Having said that, there is a lot of cash burning business, and it's like a deep pocket game, right? So if you have a money to sustain, then you can be in the game, and else you're out. That's a normal thing for e-commerce. So this company try to get a more market share, and just to pass on that benefit to the customers, to get a more market share in the form of GMV. So that's a normal
Okay,
thing.
this is all about the resistance of the
Right.
survivors. Okay, so they are going to leverage out everything they earn, I mean GMV, into the benefit that they will be getting from the IPO.
Normal
Right.
e-commerce market doesn't focus for IPO, but they do have an exit from other strategic investor, like so like strategic investor in the sense, like if you see the e-commerce, like there are a lot of companies out there, but they ultimately get consolidated into a single company, right? It's a market consolidation, and which has been like strategic investment, right? Like Flipkart acquired like these small companies called the Myntra and
Myntra,
Jabong. So
Jabbo.
it's more like a strategic investment and a market consolidation.
Okay.
What's our sustainability of the
So
companies? What is the full
okay,
form of?
then if Jabbo, so,
Anupamji, it's not GMV, it's GMV, gross merchandise value.
value.
Right.
Okay.
Sandeep, I'll take a question from others. And
During the time of market consolidation, I mean, this is one sort of hostile, isn't it? Because if a company, they have their own existence, then why would they like to be under some other company?
sorry.
Is it only the case? I mean, they all are doing the same thing. Flipkart is doing the same thing to grow their market in their own level. That is big. So it's in the same way, Myntra is doing the same thing in their own level, because they want to be acquired by other big companies than they are. Because that is their ultimate goal, right? They are going to increase their
See,
value, increase their traffic.
no,
Because
no.
you can even we can even see before that. I mean, I have noticed this. They used to have a lot of sales. They used to have a lot of discount promotions. All now, when this was acquired by Flipkart, after they have acquired this company, Jabong, I mean, Myntra was acquired by Flipkart, right? After that, Myntra stopped doing all these promotions. I mean, they're not doing these massive promotions.
Right. So see, I think this kind of company, they do have a diversification sort of interest. Like, if you see the Myntra, they are more into like fashion wear as compared to Flipkart, where they have a like lot of diversified product class, right? So yes, Flipkart do have a fashion wear also, but more precisely, they are into a marketplace where you can get a lot of like electronic items is there, like the home-based essentials is there,
Groceries
right?
and all.
Groceries are there. So these are the market, the segments which a normal market player works on, right? But if you see the Myntra, it's purely a fashion wear platform. So once this platform, they do have on customer target base, they do have an on market potential, they do have on traffic, right? So once this kind of companies get acquired by strategic player like Flipkart and Amazon, so there will be a market consolidation where a single company will operate as a market leader, right? So it's more like a duopoly market where like Amazon and Flipkart is current right now, working in India right now.
Okay. So okay. No, that's good. I'm good.
So I think that's it, guys. If you have any questions, then just let me know. And Vivekji, where are you based right now? Like, I see a lot of
before. Just before this, I used to work for a firm. There was a consulting firm, Global Risk Advisory.
Okay.
So I did some work for a startup company. So that was just basically when they were starting up. Not just starting up, just the time when they were growing. The company was growing too massively. And before that, I have also done some work for some home delivery, groceries, home delivery businesses. So I've seen this sort of thing because they were playing like maniacs because their funding was all done by other companies offsource. The company with the funding was coming from offsource.
Right.
The company now they have grown. Their market share is really high.
Okay. So Calorie, can you show the links to download documents of the webinar? Yes, I will be sharing the documents and share you the link to download the file shortly. Can you all just do one thing, like write me a test mail in my mail address so that I can forward the link to all of you. It's Saugat.skc at gmail.com, right? So that I can throw a reminder mail going forward in my next sessions also to you, all of you, right? So that would be a much help for me so that I can get a track. Just let me send my mail address. Yes. So drop me a test mail. I'll send the link, Calorie. So Anupamji, before coming to have a value decision in this kind of requirement of valuation, peer company as well as company to be merged with main company. Yes, Anupamji, like, a normal e-commerce market where the normal valuation parameters is the EV/GMV, which is called enterprise level value by GMV, which is a gross merchandise value. If you see in the first, investment, which a Flipkart, raised during, I think it was back in 2013-14. So that company was valued at around EV/GMV of around 7 to 8 times, right? Much more than that, even 10 to 12 times at the time. So that was basically emerging e-commerce market at the time. So e-commerce was growing pace at the time. So from an investor point of view, they perceive a higher growth in the e-commerce. So that's why they are willing to pay that sort of multiples. If you see the total e-commerce market all over the world, like 56% of the e-commerce is held by the China, right? So apart from that, India is a major player and the US. So almost 70% of the e-commerce is these three market giants, right? So there is always some sort of geopolitical game also, like, the US ultimately holds all the e-commerce market in India, like, the Amazon Inc., which is basically a US company holding Amazon India, and the Walmart, which is basically a US company holding a Flipkart. So ultimate holding company is the US, right? If you see Nepal, so this Daraz company is Alibaba backed, which is basically a China company. So yes, there is a traction in the market from a Chinese player in the e-commerce market here in Nepal. So these are the situation where you can get some sort of, geopolitical game also, like, just to consolidate the market. Yes, Anupam, it's Alibaba from China, where they have invested in e-commerce, which is the leading e-commerce market in Nepal, which is called Daraz. They have investment in Nepal, Alibaba. I'll be copying all the trailing mail. So it would be very grateful if you could, like, just send me a feedback. I'll be sending a feedback from in the link as well, and I'll be waiting for your reply. Any suggestions, any recommendations for the next session, that would be a great help for me, just to to improve myself. Yes, it's all my work experience sharing, and that could be a great help if you could suggest me your next the topic for the next session.
You tell something about valuing the company. I mean, you can do this in next session. Valuing some, I mean, the company that are involved in consumer goods.
Mm-hmm.
How do you value the company? Like in case of Nepal, Bhadwani is the company. So how can we value this kind of companies?
So see, we can see this kind of company in two aspects, right? One is the realistic valuation, where they have a number of stores, right? So see, like it's always for this kind of asset heavy business, there is always a floor price, which is basically the realistic value, right? So if you are going to like let's suppose Badbutini have 3 or 4 stores all over pan Nepal presence, right? They have 5-6 stores in Nepal. So we can have a general benchmark for this kind of real estate valuation for this kind of company. One thing, so that's a floor price. And from the income perspective, right? So income perspective, it's more like a so say in the Badbutini perspective, the inventory holding period is not there, right? So if a vendors wants to sell through a Badbutini stores, they do have to place their inventory in the Badbutini store for 3 or 4 months. So their working capital is always negative working capital company. So it's a very good business model. And the next thing is from a cash flow perspective, right? So definitely it's a more like a margin game. But if your investment valuing that company based on the income approach is less than if you're valuing the company based on the real estate, then you will be having a real estate valuation rather than valuing a company, right? And in terms of the comparable market multiples, yes, there is not pure play comparable right now, but there is a bench to benchmark. But we can benchmark with the Indian competitors like the Vishal Mart, V-Mart, right? So that's a major pure play comparable with the Badbutini. So that sort of company, which is purely a real estate based, retail chain, right? So this kind of company normally valued as at EV, EBITDA multiples. And apart from that, you can have a the EV per sales can be also be used as a valuation multiple. As sale is one thing, but there is always a minimum margin for this kind of companies to operate with. And also there is also one benchmark like EV per square meter, the more the big the retail store is, the more the valuation and more the footfall this kind also will look at. But EV per square meter can also be looked at for the valuing this kind of things. See one second, Excel calculation.
Thank you very much for this session.
Thank you so much. Thank you everyone for your appreciation. I really look forward for more interesting topics to be covered in the next sessions as well. And it will really boost me to share my experience. And yes, definitely you can have a cross sort of knowledge sharing sort of things going forward. Yeah, it's really appreciable by your participation, and I really look forward for all of you guys in my next sessions as well. So it would be really helpful if you could send me the feedback form showing your recommendations for the next topic. That would be a really good help. And after these sessions, I will be sending you a link so that you can download the presentation and the Excel model after this. So just drop me a mail. I have already shared my email address so that I can follow each and every one, just to send you the reminders for the next sessions. So thank you so much. Any last questions? So Anupamji, I'll be sharing the Excel model and presentation shortly. Don't worry, I'll be sharing you in person, your personal mail address. So thank you, everyone. I think it's time to.
Thank you. Thank you, Saugat.
Thank you very much.
Thank you. Thank you so much.